despite the fact that all of the companies that are making money by selling things like foods, beverages, airplanes, things like that, they're doing great. And all of the tech companies are not selling as much as they used to last year. And they're losing money. Well, not all. All right, all these companies on this list actually make money. But a lot of the tech companies are losing money, which is a big problem for tech. And so tech is getting crushed right now. Yet you guys are still investing in Tesla, Apple, Amazon, Microsoft, and Google. I don't know why. Look, it's not rocket science. Figure out which industries are going to do better and invest in those industries. So, all right, let's do this. I'm going to go to trading. I think my account is invisible, but let's say I wanted to invest in something. So I go to stocks, and the market is now closed. It doesn't matter. I'll put in a market order, and I'm going to buy Chevron because it's ExxonMobil and Chevron are hitting all-time highs, just the way it is. All right, if you guys want to be more sustainable, all right, I'm going to go to okay, Keurig Dr. Pepper. So we're going to buy and sell coffee and soft drinks, okay? So you put in the ticker. Hopefully it understands what you're trying to do. Okay, there it goes. And now it's showing me what's going on. Oh, wow, it's up huge today. I didn't even realize. Honestly, I did not realize. So I'm going to click on buy, and I want 100 shares. So that'll be $3,951. All right. Now, this shouldn't be too difficult to do. You click review order, and then you click place order. Now, obviously, because the market is closed, I'm not going to get this last closing price. I'm going to get the opening price tomorrow morning. I don't know what that's going to be. That's the problem when you place trades overnight. But nonetheless, I can still just say place order, and then when the market opens tomorrow, I'm going to get, you know, several hundred shares of Keurig Dr. Pepper, $3,951. Not that big of a deal. Okay, so in your comments in the chat, if you're still having problems finding out how to do a trade in StockTrack, then you've got to figure it out really quick because the midterms are here. So you got to be invested. If you're not invested, you're going to get disqualified. So I just showed you how to do it. It's not that hard. It's really simple. Let's do this. Let's do this next part. Let's see how everybody's doing, because that's like the coolest thing to check out. I always love to see how everybody's doing. All right, so wow, and it's different companies, different people, different traders, different groups. Yin Capital now up 5.59%. PMS Traders up 3.5%. Wenmoon 07 also up over 3%, as Brendan Wehrmark up 3%. And then we have several other people or groups that are up over 2%, including Mina Yin Meng Chen, Booba, Boo Boo, Ready Eddie, Lulu Xiao, Connor RG, Agent VC, MM Investments, Jeanette Yang only up 1.7%. But still, a lot of you are up over 1%, almost 2%. And that's really good. So I'm looking at all of these people, all of these groups that are up. And I'm really proud of you because most of you have a lot of trades. Now, some of you are just like skimping by. Sophia, Lisa, Ashley. That's 3 people on a team, and you've got 1 trade. You've got 1 stock. And it's NVIDIA. I don't know. What did you do? Wait till it crashed and there's nothing else going on in life? You bought it? Because let me tell you, that is a loser stock and a loser company right now. I guess he waited till it was really down. Nova investment team. Also, I'm gonna pick on people with only 1 trade. Lockheed Martin. All right. I'm not going to complain about that. Probably a good idea. So NVIDIA, less a good idea than Lockheed Martin right now. When you think about it, NVIDIA is not only a graphics card company and a microchip company, both of which are hurting right now, but a lot of their business, let's face it, was geared towards mining Ethereum and mining Bitcoin. And Bitcoin is down from 70,000 to 20,000. So it really doesn't pay to buy new hardware. And so that's a problem. And also Ethereum went through, what was it called? The merge? The purge? I don't need, I think it's the purge, honestly. So you don't need proof of work. You need proof of ownership. You don't even need graphics cards to mine Ethereum anymore. So the demand for NVIDIA graphics cards has gone tremendous. So keep that in mind. You just think this through logically as you're doing this stuff. All right, so we're gonna like look at what happened in the news this week, and we're gonna think this through logically and think about what stocks we want to buy and what stocks we want to sell. We've got a lot of these are blank teams here. But we still got a lot of people who didn't do anything yet. All right, if you didn't do anything, you're going to get disqualified from this competition. So all of you are going to be out. And then we have some people who are like realistic, everyday day traders. Oh boy. Oh, here it comes. Oh, yeah. That seems more realistic to me. That looks like what's been going on in the markets. Darn, and that's pretty tough. Oh, 97 trades even. Wow, 53 trades. Oof. Ooh, this is just brutal. Wow. Well, you know what? Most people who are down though are down about between 0 and 1.5%. You can make that up in no time flat. So don't be depressed. Don't be depressed if you're down just a little bit. If you're down less than 2%, you're gonna be fine. You're gonna be fine. Everybody here is gonna be fine. All right, when you get down to negative 5%, or if you're negative 18%, you're gonna be not fine so much. So I just wanted to see what you guys are doing. And you know what? Let's just see. Wow, you're not no realized losses. You're gonna hold these micro cap. Wow, you're gonna hold these micro cap biotech companies all the way to 0, huh? Oof. You guys are gluttons for punishment. Oof. Okay. I mean, these are some steep losses here. I don't even know what to tell you. 24,000. That's that's a big loss. 20,000, 22,000. Jeez. All right. Maybe biotech's going to come roaring back and you guys are going to be fine. I don't know. We'll see. All right. So I know you all want to know what's going on. Let's just go to page 1 and see what everybody's doing up there. Because I know you all want to copy. Aha. Stuff you've never heard of. This looks like a really well-diversified portfolio here. Wow. Wow. This is called good work right here. Not a whole lot of losses. A lot of companies in the green, and you've got it across healthcare, tech, consumer discretionary, energy. Wow, it's kind of an interesting portfolio right there. This one has 22 trades, energy, a lot of energy, all sorts of stuff. Wow, wow. Healthcare, okay, good portfolio, good portfolio. So, all right, so look, the good portfolios are the ones that are diversified across several sectors, and they're doing the right things. Financials, look at this, healthcare, energy, some tech. Wow, a little AMD in there. Look at this. This is good. These are good portfolios. Really well diversified. All right, Twitter. All right, that's called merger arbitrage. And all right, listen, this Brendan Wormack, we gotta face it. He's done a lot of trading, 116 trades. He's doing a great job. I think we should see what his other positions were. Not just Twitter, but buying Twitter as it's about to close into a acquisition. That's called merger arbitrage. A lot of interesting stuff here. Pinterest. You know what? They had a good quarter. That was interesting. All right, don't be buying ETFs. Don't do that. Tesla, Apple. Okay, you know what? Some diversification there. All right, so look, a lot of you are doing really well in this competition, and so I'm really happy for you. That's wonderful news. The ones who are doing the best are the most diversified, buying healthcare, utilities, consumer stocks, things like that. Not all tech, some tech, but not all tech. Don't buy a lot of companies that are losing money. Right now, this is not the environment to buy companies that are losing money. If they can't raise any additional capital, they're going to go out of business. Pretty simple. So we have to be wary of that. All right. So what makes stocks go up and down? Remember, it's earnings. And we had a lot of earnings this week. And we're going to go over each of those because the most important thing, or things, I should say, that happened this week had to do with companies' earnings. Now, in the previous week, earnings were pretty good, and we had some good earnings out of financial companies. And financials started doing really well. So add that to your list of buys. Financial companies, the major banks were doing great numbers. Their earnings were higher than expected, and they raised guidance. And so that is why stocks went up last week for financials. This week, not so much, because remember, this week we had a lot of tech companies. All the big ones reported. It was Facebook, it was Google, it was Apple, it was Amazon. And look, you could see the writing on the wall. Amazon's had a horrible quarter every quarter for the last 2 years. Ever since we got out of the tech lockdown, Amazon has stunk with stuff. You know, everybody bought stuff from Amazon while we were in lockdown, but now that we're not in lockdown, people want to go out and go to stores and buy stuff, try it, touch the fabric before you put it on, feel if it fits, and then buy it. Not buying it from Amazon anymore. I'm sorry. Amazon's earnings are just going down and down and down. We all saw that coming. Bad times. Google, same thing. Facebook, even worse. Facebook, there's a similar problem with Google. Google has 2 share classes, but Facebook is even worse because there are 2 share classes. This gets strictly to ESG, and it gets to the G part of ESG, the governance part. This is where the G part is really obvious. There are two share classes. The governance is horrible, horrible, because Mark Zuckerberg sold common shares with no voting rights to everybody. So you can buy the shares and have no rights to voting or profits. And he has a second class that gives him all the rights to manage the company. And what does he do? Instead of making the company more profitable, he invests tens of billions of dollars on the metaverse, something which may or may not be cool. I don't know. Quite frankly, I think this company is going to go to zero eventually, unless this metaverse thing really pans out. And he's projecting it's not going to be profitable until 2030. That's a long time from now. I can't even discount my money that far out. I'm sorry, everybody's out. Everybody's out of this stock. This is a disaster. So growth rates negative and declining. Changes in discount rates going up. It's horrible times. And we're going to see another one of those next week when the Fed raises interest rates another 75 basis points. And it's all about future expectations. So let's face it, we had all of this on display this week. So we had earnings reports, and they may have been better than expected or less than expected. But at the end of the day, we had changes in growth rates that were negative, and our future expectations are negative. And what we're going to have this week, discount rates are going to go up plus 75 basis points, or as we call them, bips. So we're going to get 75 bips on our discount rate this week. It's going to be horrible. So always keep this in mind. Now we're going to see this again and again and again. Look at all the things that are going from right to left that have gone from red to green. Those are the industries where you should be investing. These are the industries with pricing power. It's consumer staples, it's food, it's beverages, it's energy, it's hotels, it's airlines. These are all the companies that are making more money right now and are being able to pass through their inflation straight through to the consumer. Now, for a lot of these companies, let's look at airlines, for example. You've got a unique confluence of situations here where people have not been able to travel for over 2 years, and they are missing weddings that have been delayed, reunions, class reunions, family reunions, vacations in general, all these things. People just want to go out and travel. They just want to travel right now. And so they're doing so. And they're buying up tickets on airlines. And airlines had rising costs. Their number one cost is not the planes, it's the jet fuel. And fuel prices were going up. So they raised prices because the planes were full. So they raised prices, and now the fuel prices are down and decreasing. So they kept the prices high. Now they're making more money than ever. And typically, what you would see from both the energy industry and the airline industry is that they would just simply add capacity. They would add more planes, more routes, but they can't. They're out of pilots and they're out of planes. So they have a forced discipline, and they can only raise rates. And with costs going down and they're raising prices, that's a good place to be right there. This is what you have to look for. Think it through, people. Think through the macroeconomics. All right, so let's get on to earnings. Look, we know it's going to be ugly. We've got Meta that reported this week. We had some other good reports and bad reports. Thermo Fisher, ADP, ServiceNow, Boeing, Canadian Pacific, General Dynamics actually did really well. Boeing was like disappointing, yet not surprisingly disappointing, and the stock actually didn't do so bad this week. But for a lot of the defense companies like General Dynamics and Lockheed Martin and Raytheon, they actually did okay. But for the tech companies, we knew the stocks were going to report bad earnings, and they did. And you know what happened? The stocks went down, and they went down a lot. Meta, formerly Facebook, I just got to say that, all right, how many of you have a Facebook account? How many of you use Instagram anymore? All I see on Instagram these days is people using TikTok and posting their TikToks to Facebook and posting their TikToks to Instagram. So Meta is in the trash. So it's like anything with technology. There's going to be a new technology that's going to take over. Right now, it's Snapchat and TikTok taking market share from Facebook and Instagram, which is why they changed the company's name to Meta prematurely, because they're trying to look at the future. It's 10 years away and they can't get there yet, but they still have to pretend that they're going to get there. And in the meantime, they're losing so much market share. It's unbelievable. It just stinks. It stinks. So here's what happened.
Well, shares of Meta are cratering after missing earnings estimates and seeing a decline in revenue for the third quarter. The media giant reporting its Reality Labs division lost over $9 billion so far in 2022 and forecasting operating losses in 2023 to grow significantly year on year. Meta joined the growing list of disappointing corporate results from tech companies. And as there's certainly a lot to parse through here. I mean, we can start with that Reality Labs number because remember last year, this is a company that made that pivot. They changed the name of the company saying we're going to double down on the metaverse. And yet here we are saying that, look, they lost $9 billion so far, roughly $4 billion in the quarter. We heard a lot of use of the word patience on the earnings call yesterday with Mark Zuckerberg saying, we know this is a long-term bet. We think it's going to pay off. But certainly investors today saying, well, that's a long way out here. And I'm not sure where the company is headed right now when you think about so much of their revenue is still driven by digital ads. Things not looking as good in that direction.
Yeah, that's right. So you're seeing a slowdown in digital ads. We know the issues that Meta has also had with the iOS privacy issues. But the big problem is basically that you're saying long term, believe us that we will be doing well with this metaverse investment that we're making. And investors are saying no. I mean, no, not especially right now. I think that the timing of this is very difficult for them because we are in a tighter monetary policy era. I know that Meta has big pockets, but still investors don't want to see this kind of investment in something so far out in the future when there's so much uncertainty right now. I mean, Facebook was a game changer when it came to social media. Will the Meta be a game changer for the metaverse going forward? That's yet to be determined. And Mark Zuckerberg is really asking investors to believe in him and this strategy, but it's far out.
Well, and the other thing to watch here is the regulatory environment. When you think about how Facebook, now Meta, became the company it is and were able to grow their platform, a lot of it was through acquisition. You look at something like Instagram, you look at WhatsApp. Well, now they're in an environment where they're certainly not being embraced from regulators. They're not able to go out and acquire companies. And I guess the question is, if they could, is there a play they would make here within the metaverse? But that's going to continue to weigh on them too, because essentially they have to innovate their way out of all of this. And I'm not sure that the track record necessarily speaks for itself when you come to what they're doing internally versus how they've been able to grow through acquisition over the years.
Yeah, and metaverse is really something that, I mean, this should be more of a startup. This is what you're talking about is when you're talking about acquisitions. So which other companies would they acquire in this field anyways as well? I mean, this
still
is
nascent, very early. Yeah.
So early on. I do want to point out that when you take a look at the market cap of Meta right now, I mean, this is what also is scaring investors. We have seen a slow and steady decline, and right now in the S&P 500, it is number 21 as far as market cap is concerned. It's behind ExxonMobil, it's behind Chevron, Procter & Gamble, MasterCard, Home Depot. So it's fallen quite a bit.
It's funny that they mentioned that because those are all the companies that are doing really well right now. ExxonMobil, Chevron, Procter & Gamble, energy, consumer staples, those are the companies doing well. And so, look, here's what happened. We all knew this was going to happen. Their betting the bank on you putting goggles on your face and trying to participate in a fake universe. After what happened during COVID, I don't think that's going to happen. People want to go out and have real experiences again. They want to travel. They want to see the pyramids of Egypt. They want to go to see the Eiffel Tower. People want to get out and do things again. So this stock going to zero. Tech, a lot of tech is going to zero. All right, so next we had up Apple and Amazon, MasterCard, Merck, Royal Dutch Shell, McDonald's. McDonald's had a pretty good quarter, I'll be honest. They did really well. T-Mobile is okay. But I mean, those things are to be expected. Now, so what we expected out of Apple was that the quarter is going to be kind of mushy because they introduced the iPhone 14, but it was after the end of the quarter. And usually when they do that, what happens is that people hold off on buying iPhones and they wait for the new iPhone to come out, and then they buy iPhones. But this one was kind of like a short cycle. They didn't really announce that it was coming out, and they just sort of like produced it. And so there wasn't that big of a dip. So the results were like pretty good. I mean, they weren't great. I'll be honest, they weren't great, but they're pretty good. Amazon's results were pretty bad because we all knew that was going to happen. It's another one who was I'll call them a COVID darling, where we had lockdowns and everybody stayed home and bought everything from Amazon. Everything was delivered online. And now we don't want that anymore. We want to go out and buy stuff. So here's what happened.
Want to get down to the New York Stock Exchange. Our good friend Jim Cramer. What a market this morning between Meta on one side of the universe, so many other companies coming in with earnings better than expected. Meantime, got this new GDP print. Make sense of it for us.
All right. Well, I think there's a tremendous amount of money coming out of technology in general, coming out of big cap, and going into companies that are have cost control and see some light at the end of the tunnel. There are companies that recognize what you have to do when you have to batten down the hatches, and there are other companies who don't seem to understand that we might be into tougher times. So I look at it like that. I also think that GDP number not as important, maybe durable goods. Everything that is that I'm seeing, really, Andrew, is an extraordinary revulsion to big cap tech. Maybe Apple can save that tonight, maybe Amazon. But the notion of companies that can do spending that has no end to it, they're finished. They're finished as places. They're
finished. They're finished as
places to invest.
We keep talking about this falling knife, as if the knife continues to fall. Though there are people who look at this and say,
look, I'm looking at the money coming out. Where's the money coming from to buy to buy industrials? It certainly isn't coming from new people saying, "Wow, it's time to put money in the stock market," because they get such a great rate on the 2-year.
All right, I'm going to pause it right there. The point he just made is a key point. Let me turn my camera back on. All right, this is a key point. Very important that you guys understand how this works, because, I mean, it takes a long time investing in the markets before you really understand how this works. But I'm going to tell you how it works. It's happening right now. There's a thing called sector rotation, and what he's describing is called sector rotation. What he just said is that where is the money coming from to invest in industrials? It's not that new money is coming in where people said, wow, it's a great time to invest in the stock market. His point is the money's not coming from outside with new investors saying, wow, it's a great time to invest in the market. It's coming out of somewhere else, and it's coming out of tech stocks. Tech stocks are getting crushed. They're going to continue to get crushed because people are going to use it as a source of capital. They're going to take money out of tech stocks. They're going to put it into consumer staples, into healthcare, into utilities, in basic materials and industrials. And until that cycle stops, we're not going to see the end of this sector rotation. Now, trust me, these things change on a dime. Maybe there's going to be some great data point next week where Amazon is suddenly putting up huge numbers again, and for some reason. I can't imagine why that would happen. But let's just say hypothetically it does. And then suddenly the money will rotate back out from industrials and consumer staples and tech back into technology. This happens all the time. Classic sector rotation is going on right now, though. So the money that's going into these consumer staples, utilities, healthcare, basic materials, industrials, it's not new money. It's not new people getting involved in the markets and saying, hey, I want to invest in a factory. No, it's people saying, I'm tired of losing money in tech stocks and I need to put my money somewhere else. And they're rotating into these other sectors. That's exactly what's going on. And that's why you should be invested in these places as well.
I think it's money coming, rotating out of companies that have dominated this market for the last decade and into companies like Caterpillar who actually know what the hell they're doing.
Are you thinking that the tech companies that I think that you're disappointed in are going to get religion, if you will, and get disciplined? And what does discipline look like?
You know what they are? I would call them atheists. They believe in nothing.
I think that's a nihilist.
We were also talking about Elon Musk earlier today as he was walking into Twitter holding the sink with him. Looks like if you were arbing that, you're a winner today, or will be a winner later this week.
Well, when you incorporate in Delaware, you tend to get the benefit of the doubt. And I think that Elon, I think he'll probably do a good job because he's masterful and he's got an idea that we probably don't know in our heads. He's probably got something. I don't think he's going in there idly. I would trust him more than anyone in tech. He seems to have a concept of making money. He seems to be liking the concept of making money.
You think 5 years from now we'll be talking about that company, IPOing at a valuation meaningfully higher than what he's paid for it?
Yes, because it'll look nothing like the company we have now, which is a company of declining revenues and no ability to do any commerce. And I think that Elon Musk is addicted to doing commerce and making money, which is one of the reasons why he's so pleasurable.
Okay. So, look, Apple posted their earnings. They're okay. They weren't great, but they weren't as bad as the other tech companies. And look at that chart. They took off. So by the end of the week, tech was doing better and the whole market was doing better because, well, the earnings weren't as bad as they were on Wednesday and Thursday. Apple came out and did an okay job. And Apple, it quite frankly, is one of the biggest companies in not only the Dow, but the S&P 500. It is so huge that all of 499 companies in the S&P 500 could be down. But if Apple is up, the S&P 500 is going to be up. That's how big it is. I should have posted this first. So then we had Amazon before that.
And then there's Amazon tumbling in the pre-market after missing on Q3 revenue, projecting weaker holiday sales for the current quarter, Jim. And as normal, their range is pretty wide on the quarter.
Right. Look, there's no doubt about it. Amazon did not deliver anywhere near what people thought. What I was trying to do last night, David, I didn't understand, trying to figure out how to value things. I mean, Amazon Web Services, let's say it's doing $80 billion. It's got $80 billion. If you give it, say, a 10 multiple, maybe that's just random, but you give it a 10 multiple. Now you look at the new Amazon with a market cap that's dramatically lower, and you say, well, wait a second. I'm getting pretty much the rest of the company for very little money. The ad business was very, very strong. No one disputes that.
Yep. Retail was not bad.
Retail was not bad. The projections, I think, reflect maybe that some of their customers aren't doing that well, and they're giving them some breaks. How about that?
But what do we make of the slowdown in growth at Amazon Web Services? Is it because of continued and increasing competition from the likes of Google and Azure and others, or is it a reflection of a slowdown in the overall economy?
I think it's the latter. I think it's reflection, and that I think that customers themselves are hurt. I think that one of the things happening, things are happening with such a great speed. We should have realized, of course, when the Fed raised rates with such great speed that the narrative changes quickly. But I think some of the customers are saying, listen, we need a little break here.
Just let's step back. Let's not commit.
Yeah. And I think that, to me, Andy Jassy, who is, I think, getting a little bad rap here, I think Andy Jassy is going to take care of the situation.
Right.
Now, it's very difficult to say that there's one person who can come in and take care of it, but Jassy's going to take the top. He knows how to.
Oops, let me just stop right there. I screwed it up. let me get back to right where they were, because I want to highlight
that there are a lot. But the startup, tomorrow's going to win.
A surfeit of
for this moment.
Customers for Amazon Web Services who are focused on controlling costs.
Right.
Which is what you might anticipate in an environment like this.
I think everybody's skittish. Look, I didn't think Amazon, when you give a forecast from Amazon.
Yeah, here we were back there. All right. So here's an interesting conversation that's going on about Amazon right now, and they're talking about it live on air. And I want you to understand what's going on. So when you look at this chart right here, you can see that clearly we've got a situation where the stock was running up into 2019, then it dropped during COVID, and then it rallied super hard because they did a great amount of business. And unfortunately, a lot of investors interpret that growth as growth in perpetuity. And of course, no growth like that lasts forever. In fact, it turned flat to negative. And so now the stock is back down below where it was in 2018, 2019, which is shocking because they're actually doing a lot more business than they were then. And their streaming services are doing well. So what he was talking about in the beginning of this call was basically what's called a sum of the parts analysis. And I know all of us have talked about this previously, but I just want to reemphasize this again because he talked about how they have their streaming services, they have their retail business, they have advertising. All of these things can be valued separately. And his point, Kramer's point, was that if you value this company based upon one of these things, then you're getting the others for free, basically, which is kind of odd, which makes it look like the stock is kind of cheap. And look, I'm not going to say that the earnings are not going to continue to go down or decelerate, because clearly they're in a deceleration or negative growth cycle, which is going to put pressure on the stock. Nonetheless, we're reaching a point where the stock is kind of cheap based upon all these other things, because they have Amazon Web Services continues to grow. Their retail business, not so bad. It's not as growing as fast as it was, but it's not so bad. Advertising, it's not as good as it was, not growing as fast as it was, but it's not so bad. It's not losing money. And so if you add all these things up and do like a relative valuation of all these different items, all these different segments, and then add them up, you'll probably find that this company, its stock is a little bit undervalued at this point.
I mean, he knows how to fire. He knows how to right the ship. But I do think that Amazon Web Services is now undervalued within the business.
You do. I mean, as you said, $82 billion run rate on sales.
But maybe
again,
is the 10 multiple wrong?
28% year over year. That excludes foreign exchange impact.
Right. I mean, you got $1 billion. You know, you have a company that's valued at $1 trillion, and you've got this thing you could value at $830 billion. So is the rest of it worth 170? That's all it's worth.
Right. I mean, it would seem like that might very well be the case.
Right. Apple's interesting. More interesting.
Well, yeah. I mean,
go ahead. I'm sorry.
No, I was just going to point out to Carl as well. To your point, Jim, they did say during the call that they've seen an uptick in customers for Amazon Web Services who are focused on controlling costs.
Right.
Which is what you might anticipate in an environment like this.
I think everybody's skittish. Look, I didn't think Amazon. When you give a forecast from Amazon, you're going to be very wide in what you do. I think that what you want to think about is Amazon next year, and Jassy riding the ship, and really, unfortunately, they're very overstaffed still. See, I had thought that they had made cuts that were meaningful. Maybe they're just in the wrong place, David. You know that they have far too much staff for this moment.
Sorry,
they have far too much staff.
Staff, yes.
The costs are way out of whack.
Well, Carl, Amazon hired more people in the quarters during the pandemic than we've ever seen a corporation in history hire.
And they hire the army. They have to let people go. The war's over.
Well, one notion that's being talked about this morning is that AWS grew out of a surfeit of startups. when money was cheap.
Yeah,
and then that obviously is not going to continue to happen at the same pace.
I actually agree with that to some degree. I also think that there are a lot of companies that are just not doing that well and saying, listen, we need a break here. But the startup cause, that's like a new cause and effect, that yes. But remember, you're not getting the stock at the top. I guess I want to make a case for this company as a longer-term winner, but not something you can just say tomorrow's going to win. I think Jassie's going to make a series of very smart moves that will make you feel that the costs are back in line. And the costs are just out of whack. And you can do something about that because demand's not out of whack, except for some Amazon Web customers. The actual company of Amazon has great demand, but they are really overstaffed.
And you know what? You can say that about Google, and you can say that about Facebook and all these companies. A lot of them didn't have declining revenues, but they had, you know what they had? They added tens of thousands of employees, and their revenues didn't go up that much. And all of a sudden, their revenue was growing slower than they thought. And so their earnings per share went from $1.50 to 80 cents. And that was across the board at tech. They've been on a hiring spree for the last 2-3 years because they can't get enough employees and they're trying to bid out everyone else. Now they've got a ton of employees and they have nothing to do, and the earnings are not going up. It's a disaster for them. So, all right, Amazon, Apple wasn't too bad. Amazon actually wasn't too bad either, but it was down for the week. So look, it's one of the big names in tech that will actually drive the entire market down. And then on Friday, we had the good guys reporting. Now, I know we're trying to be environmentally friendly. You don't want to invest in ExxonMobil or Chevron. But look, there's an environmentally friendly energy company down there. One that does green energy. Don't lose sight of the fact that energy is energy.
Chevron shares are looking good this morning after reporting results up at looks like up about $4 now, $4.61 for everybody in the mainstream media. $11.6 billion profit, $11.6 billion profit for Chevron. If you do it on an adjusted basis for earnings per share, so you can compare it to estimates, it was $5.82, and the street was looking for $5.10. I guess we can do upstream earnings, $8.56 billion, downstream $3.52 billion. Do we do their revenue numbers, or do we need to always say, well,
the revenue? I think you can.
You can. It's 68.
Didn't have as many.
Excellent. $68.7 billion, which is well above where the street was. Maybe it's not apples to apples, but they were at 59. Just for comparison's sake, Apple's earnings fell 11% to $19.4 billion. Right. Well, so this is a lot of money. This is a lot of money, but 11.6 is it's not. Yeah.
I mean, the big deal is this is so much more than what they had earned a year earlier. If you're looking at the same quarter a year ago, they were looking at closer to, it was $1.60 on a diluted basis.
Right. This is where you get the windfall profits discussion
on an adjusted. So you're going from 171 to 582.
Yeah,
and that's where you start getting.
And oil went from 50 to wherever, and then in 2020, most of the industry lost money. Chevron also said it would buy back up to $15 billion in shares this year. That's raising the guidance for the buyback.
Yeah, before they were saying $5 to $10 billion. Now they're saying $15 billion in money coming back. They say that they also doubled their investment compared to last year in both traditional and new energy business lines. I think all of these energy companies are going to be trying to show what kind of capex they're putting back in, how you will be able to grow what you're taking out of the ground at some point as a result of that. And Mike Wirth, the CEO and the chairman and CEO, saying that the company also lowered its debt ratio to under 15%. So they did things like pay off pension settlement costs of $11 million. They did say foreign currency effects increased earnings by $668 million. So the opposite of what we've heard from some of these big international companies, foreign currency actually having a positive impact.
So they're investing in both. And actually the Manchin deal that we're talking about is much smaller than what the real the Green Lobby wanted, and is more of an all-in There's something for everyone, and there's not just solar, but there's also hydrocarbon developments too, in the 300 plus billion that we're talking about now.
Yeah, interestingly enough, so energy companies had a great quarter, and
Chevron.
And they are
Chevron.
Redeploying that profit into increasing production, which is what typically they would be doing in an environment like this. And I don't know. I mean, as an aside, probably a snarky aside, one of the commentators said this is where the windfall profit tax comes in. And yeah, every time this sort of thing happens, the government does threaten to put in a windfall profit tax. And then, I guess the logic is they take all the money away from the oil companies and to redistribute to the people like Robin Hood. Yeah, then they can't increase production to get costs down. So we all have to suffer higher inflation, higher gas prices, and higher oil prices. So, I mean, that kind of thing never works. Anyway, they never do it because they talk a good game, but that's not ever going to happen. Silly stuff. Good quarter for energy companies. Look at that chart. That's from the lower left to the upper right. That's good. ExxonMobil, same thing, hitting an all-time high. Hard to believe, right? An all-time high. Energy prices are not heading,
including ExxonMobil, which is just out with its earnings. We told you about Chevron just a few minutes ago. Chevron beating expectations, and the same story with ExxonMobil. The company came in with, if you're looking for net earnings, Joe, that number that everyone's going to be focused on, $17.85 billion in earnings. If you break that down on an earnings per share basis, it was $4.21 a share, and that was better than the street was expecting. Street was looking for $3.74. Now, on the revenue line, it looks like it did miss the number, or the expectations on the revenue line. It looks like revenue came in at $115.68 billion. The street was looking for $132.7 billion, but we should point out that there are far fewer analysts who put in an estimate for revenue than those who put in an estimate for earnings. So the earnings is normally what we focus on when it comes to ExxonMobil. They also talked about how they are spending capital investments, CapEx, was $9.5 billion for the first half of 2022. They say they are on track with their full year guidance for CapEx numbers. And when they were looking through some of these things, they're talking about new lower emission initiatives that included 4 large scale carbon capture and storage businesses. What happened with this? Darren Woods is saying in this release that Darren Woods, the chairman and CEO, that the quarter reflects what he called their focus on fundamentals and the investments that they put in motion several years ago and then sustained through the depths of the pandemic when oil prices went negative. They continue to put some of this in. We are going to get the chance to talk to Darren Woods, the CEO of Exxon. That's an exclusive interview that is coming up at 8 a.m. Eastern.
All right. So again, we got a chart going from the lower left to the upper right. Listen, I know it's a sustainability investment conference. We've got this. So we've got this. Find energy companies that are engaged in lowering their carbon footprint and engaging in sustainability and things like that. And don't demonize every company in the world just because they might produce energy. And there are a lot of green energy companies too. If the price of electricity goes up, it doesn't just necessarily have to be generated from oil or natural gas. It could be from wind or solar. Or look, Next Energy, NEE, great utility that engages in green energy. All right, so here we go. Here's what happened last week. Let's wrap it up. Let's talk about what happened last week, and we're going to talk about what happens this week, and we're going to get the heck out of here. So new home sales. Surprisingly good, and that was like a savior for the economy, because obviously if new home sales go down, if new home construction goes down too much, a lot of people are going to lose their jobs. So not worse than expected, and a little bit better than expected actually. So I mean, there was negative pressure on the stock market because it was a positive number, so the Fed might raise interest rates. Yeah, they're going to raise interest rates 75 basis points. We all know that. But, there are the people sitting on the fence who are thinking, wow, maybe if there's a really bad economic number, maybe they won't raise interest rates 75 basis points. And so they're bidding up stocks and bidding down bonds and playing that arbitrage game. But look, they're going to raise 75 basis points. It almost goes without saying. Durable good orders was a little bit negative. Well, not negative, a little bit lower than expected. Consensus 0.6, but it's growing. It's growing. So look, industrials still a good place to invest. GDP growth rate is pretty good. It's a lot better than last quarter and a little bit better than forecast. So I mean, these are good numbers economically. So it's okay to invest in the stock market. And on Friday we had personal income, which was a little bit better than expected again. So even consumer discretionary, travel stocks, hotels, airlines, probably still an okay place to invest. All right, let's look at what's coming up let's look. All right, so yeah, so we had this, and then we had some bad tech earnings on Wednesday and Thursday. And believe me, I got to tell you, honestly, I bought puts on the QQQ here. And so I enjoyed all those bad tech earnings on Wednesday and Thursday. That was like fun for me. I made money off that. And then we got other companies that are reporting good. And, this is ExxonMobil and Chevron right here, primarily. And so the other, and Apple had good earnings too. So we're kind of digging ourselves out of a trench right now, climbing the wall of worry. And so as long as we don't have any more bad, crappy, terrible tech earnings, we might be able to claw our way out of this. Consumer sentiment, though, is not so good in terms of inflation expectations. So, this was not a good thing. So that's going to put pressure on stocks because we had that report. And so that means the Fed can't really stop cutting interest rates if inflation is still high, which it is and increased. And the expectations are that it's going to continue to be high. So we need this to roll over and come down. If inflation expectations go lower, then the Fed can start cutting interest rates, or at least stop raising interest rates, one or the other. All right, so here's what we have the week ahead for the Federal Reserve. It'll be a very busy week. With the Federal Reserve's interest rate decision, big Federal Reserve's interest rate decision. This is going to be the most important thing this week because we don't have a lot of earnings reports from big companies in the Dow or the S&P 500 this week. But we have the Federal Reserve's interest rate decision. That's the biggest thing. We got the labor report, another big one. And of course, other earnings reports. Also, investors will closely be watching central bank meetings in the United Kingdom, Australia, Norway, and Malaysia, and GDP growth and inflation rate figures from the Euro area. Finally, China will be releasing manufacturing and services PMIs for October, and PMI stands for Purchasing Manufacturers Index. But as we all know, China will make up fake numbers like they did for their GDP growth last time. And even though they had COVID lockdowns in major cities, they said GDP growth was 3.5%. It was fake, and we all know it. All right, so here's what we have coming up next week. A lot of very, very important things. So Institute of Supply Management, Purchasing Managers Index, that's a big one. Some JOLTS numbers, that's kind of important, but not that important. ADP employment change, it's the company that does payrolls, so they can see how many people are hired and fired. Then the big one, at 2 p.m. on Wednesday, and 2:30, we got the Fed interest rate decision. There'll be an interest rate decision, and then the press release will come out with a text. And everybody who writes code and uses any kind of AI is going to write a program that's going to parse every single word to find out if it's positive or negative, and they're going to trade on that regardless of what it actually means. The AI is going to make the decision and trade stocks. So 2:30 p.m. on Wednesday is going to be a crazy, crazy time. The stock market's going to be very volatile. But do yourself a favor. Don't write a program to read that. Read it for yourself. Understand what it means, and then trade stocks accordingly. Okay. For the rest of the week, Thursday, balanced trade, ISM non-manufacturing, kind of important. And then non-farm payrolls for October are on Friday, and the unemployment rate comes out on Friday as well, 8:30 a.m. before the market opens. So a lot of important economic reads. The Fed is going to be the biggest one. For earnings next week, we've got a lot of important ones. Not as important as last week. So 2 weeks ago, we had financials. All the financials reported. They did great, and all the stocks went up. This past week, and I warned you, tech reported their earnings were going to be bad, and they were bad, and all the stocks went down. So this week's a mixed bag coming up. We've got some pharma, we've got some energy, we got some tech, got some consumer staples, some consumer discretionary. It's a mixed bag coming up this week. So none of these companies are really huge, like the big tech companies and the big financial companies that really move the markets. The next day, we've got more biotech, technology, healthcare, consumer staples, again, consumer discretionary, healthcare. So it's a mixed bag every day this week. So I don't think there's going to be a day when it's not going to be like last week where there are 10 tech companies reporting and they all stink the place up and they all miss their numbers and all the stocks go down and they drag the whole index down. I don't think that's going to happen because we've got a mixed bag. We've got big companies that are all across the board in different sectors, and some are going to do really great and some are going to do poorly, and we'll wait and see what happens. By the end of the week, we got Toyota, a big consumer discretionary company. ConocoPhillips, when you need oil, call the cops. Some pharma. You know what? PayPal has been troubled the whole time. I can't get on board with PayPal because you know what? The only time I ever use PayPal is because it's the only way to buy stuff on eBay, and then they lost that exclusivity deal with eBay, and now they're just sort of out there in the wind. It's not the same. I can use my credit card to buy stuff on eBay. So anyway, Starbucks, Cigna, Regeneron. All right, so and a bunch of other companies. All right, so that's it. So this week is going to be not as volatile due to bad earnings from tech companies, which is what we had last week, and I warned you about that. This week is going to be more about what's going to happen with the Fed on Wednesday, and if they decide to raise rates or lower rates. And the fact is, they're going to raise rates, and there's nothing you can do about it. So it's going to be a bad week on Wednesday because they're going to raise interest rates 75 basis points, and I don't care what the economic reports say. That's what they're going to do. We all know it. So anyway, that's it. Anybody have any questions? Thanks for coming in for a market update. I love telling you guys about what's going on in the market. Adele says that's my birthday. Happy birthday, Adele. It's my daughter's birthday as well, so wonderful news. Anyway, any questions for anybody? If you guys want to talk about what you're doing with your strategy in the sustainable investment competition, that's fine. Or any other investment competition for that matter, that's fine. If you want to book some time with me or hit me up on my WeChat or my email, that's fine. And I can help you out with your strategies.